Are investors quietly bracing for credit stress? Here's what a surge in HYG put options is signaling, and how it could impact your portfolio. On June 18th, traders ramped up downside protection on the iShares iBoxx high-yield corporate bond ETF, known as HYG. That move points to a more defensive stance toward lower-rated corporate bonds, often called high-yield or junk credit. When put activity in HYG rises, it's usually a hedge against falling prices or wider credit spreads. And because high yield is a key barometer of risk appetite, those hedges can echo across stocks, loans, and cyclical sectors. Why does this matter now? Markets are weighing inflation, interest rates, and earnings. High-yield issuers are sensitive to all three. If spreads widen or rates stay high, funding costs rise and refinancing gets tougher for lower-rated borrowers. Options are where we often see caution first. A pickup in HYG puts can precede moves in cash bond spreads and higher equity volatility. What changed versus the recent calm? Demand for protection is up, with more hedging flowing through ETF options instead of single-name credit. That points to a search for liquidity and speed. The timing clusters around key inflation and growth releases, which raises the odds of faster position shifts. And insurance isn't cheap. Put premiums have climbed, a sign of stronger demand and lower tolerance for drawdowns. What are the market implications? For credit investors, elevated HYG put activity can foreshadow wider high-yield spreads, softer total returns, and bumpier mark-to-market. Near-term maturity walls deserve attention, especially for lower-rated, shorter-dated issuers. For equity investors, weakness in high yield often lines up with underperformance in cyclical and highly levered stocks. Factor tilts may need a nudge toward quality, stable cash flow, and balance sheet strength. For ETF and options traders, HYG remains a central liquidity hub, and options flows can influence intraday pricing. Here's the practical takeaway. Treat HYG options as an early warning gauge for risk appetite. If protection costs rise and activity builds, stress can migrate into broader markets. Consider how your portfolio would handle wider spreads, tighter financial conditions, and a slower earnings path. Emphasize quality, liquidity, and staggered risk, and be deliberate with hedges rather than reactive. Want the deeper breakdown and data behind these moves? Read the full article at finlitica.com.